In this video, we're going to talk about trade explanation and money management. If you ever wondered why you're not making money when it comes to trading, mostly the problem is because of the money management. That means how good is your trading signals? That means how often does it occur? And then what is the money opportunity? That means like, can you put in $100 to get $500 in average out? Or is it just some usual trading strategy where you can just put $100 in to get maybe $200 out or only $50? Where you need to have a higher strike rate. So first of all, this is a 1 minute chart. We have 60 candles within 1 hour. And when we make the chart smaller here, then you will see that the market was literally pumping up here. So there are sort of two patterns what I want to talk about here in this video. The one is where you see that the market is just like in a consolidation phase, coming back in after reaching a high or a low. That means it goes above it, comes back in, it goes under it, it comes back in. It just like stays inside. And in this type of scenario, we can trade from outside to inside. And we actually don't want to trade inside here. Only if we can see that the market maybe went down here, doesn't want to go below outside, and now presses up to this high, then we have some trading opportunity here. The second pattern, this is what we're going more to talk about with this trade example here, is that when you see the market is consolidating and goes always above highs, but cannot touch lows, not at all. I'm talking about like, just like sometimes it's okay, as you see, for example, here, but most of the times we have higher lows, we have higher highs. And that means when you see that the market retreats, like comes back like that and like goes up, it makes more sense that the market wants to go to this newest high or to this older high here than, for example, here to one of these lows. So we have to identify always the direction. So when we go here now, we just look at the past hours. You can see here, for example, that the market has here this high here and here. Market was just a bit wiggling around. And we started our trading here where my mouse is here on the right side here. The thing is just like, you look at the past 2, 3, 5, 7, 8 hours. And when you see here that the market was doing here higher highs and not lower lows, this is something which shows us that the market just wants to go higher. That means here higher high, higher high, higher high. And then here you see a low where the market touched, but it didn't go below it too much. You can see here clearly that the market here did some higher highs, higher lows and higher highs. So when you see that the market here, for example, here is a low, and then here you see some structure. What counts is that when we start our trading here where the X is, you just see that the market here rotates higher. This is just what you want to see to identify the direction. Because usually when you see that the market is consolidating, that means here, just like in one area, we don't want to place trades. What is just important here, that before we trade, we always look in the past. By the way, if you are somebody who wants to learn trading, I appreciate, by the way, that you follow this channel, like this video. You can sign up under this video and you can start with your trading journey. That means if you want to make a living out of trading, or if you're especially a business owner, for example, you have some employees and you want to get this one into, just sign up under this video at tradewithjd.com and I'll reach out and figure out if I can help you out, give you some exercises. And the difference between other people, how they do it and how I do it, is that I do everything in person. That means you would be talking to me, we would be sitting down together on the chart and do those exercises also together. And then we look forward that we implement this, what I'm showing you here, that you can just like trade within 1 or 2 hours. Okay, let's get back to the chart. So here it's very important to understand that we look at when we have a consolidation phase a bit on the back. Do we see that it makes sense that the market's shifting up or down? And then we look at targets. That means here we have smaller highs, what makes sense where the market likes to go to. This is what I mean, those older highs. But we have also a very new high here, what is just coming from here. So this high here, right? I have here a lot of indicators and I'm going to remove here all those indicators that you see here because it just doesn't make that much sense right now to have so many indicators inside. I will just leave inside the one-day VWAP and all the indicators. What I really love is to trade always a color switch. Why a color switch is because we will have it enough. If your trading rule set is to trade any green or red candle, the problem is you would have 60 trading opportunities going up or down. But if your rule set is you only trade color switches, you're limiting yourself, what is actually really, really nice, because it makes also sense, because you want to see the seller side and the buyer side at the same time before you enter a trade. That means here, for example, you see here how the market comes down with red candles very aggressively. And then when you now look closely, if you have a bit trading experience, if you just look at candles, you will see that these two green candles are pretty stronger than the other green candles where the market was going down. So it's all about, this is something what an engine cannot do. It's something what you need to do with just logic. Because in the exchange, these are also real humans buying and selling over a computer, just like by scripting something, or for example, also live on the computer, clicking like you and me. And when you see, for example, here, the market has two red candles and a small green candle. Now does one long red candle and just a small green candle. One long red candle again and just one green candle. So as you see here, the pattern is just like a green candle. A pattern interruption is if something happens, for example, like suddenly two green candle occurred, and each of these, one of these green candle was longer than each of these single green candle here. And this is active reading, what is just important, and this comes with experience, if you of course understood which market also to take, right? So by the way, so you find here the red and the green candle, the color switch is here. And instead of putting my entry here and the stop placement here, because this is pressure against, my rule set says I need to always trade a color switch. That means my entry should be after a green candle closes. That means here. My stop placement should be there. I'm adjusting here, let's just say $500 here, for example, for this trade. If I adjust here, for example, like $500, so as you can see here, this would be like a $400, $600 adjustment here. Here would be a $350 adjustment. What I did here, I did like a $350 adjustment. What I did, that's why you can see here that I lost here at $300 on the first trade, is that adjusting here $300, for example, but then going for, as you can see here, the risk reward ratio here says 5, going for 1,750 to this line up here. You can see on the right side, the market didn't made it there, but it's not a big deal. I'll come to this later, why I exited here earlier. And this is something what's very important when it comes to the money management. That means instead of just entering the trade after trading signal, I know exactly here was my color switch. Now you see that the market was going down. It did a wick. I really love wicks because wicks are showing us that the market doesn't like to stay there. Wicks are always showing you, if you have something to write down or like if you can memorize that, wicks are mostly areas where the price is just a very short amount of time. It's very interesting, by the way. And candlestick bodies is just like a price area where the market likes to stay a lot. So by the way, so that means like the market did a wick down here, a long wick like as it did here also. It started to wick here 1, 2, 3 times a bit here, but that's not just the crucial point. The crucial point was here, those two green candles, keeping it simple. Then I entered my trade on the price level of this color switch. Very important because I have a reference of a signal, so I'm structured. My stop placement was here on this low, and a very famous pattern, you might have seen this somewhere with your trading, is something what's really cool is that when you have a low like that, and now the market starts here to make a higher low. So we call this sort of as a stop out, it will stop out people, and then from here to here you have a higher low that the market continues there. So it's sort of, it's not guessing, it's like we saw the pressure the past couple of hours before then the market was going higher. You see pressure, like the length what the market is doing up is longer than the length down. This shows you also pressure. And then from here on, because the market did this pattern of like an interruption pattern, it shows us that the chance is high that here the market wants to go on to this high. So that was the main reason why I entered here this trade, placed my stop here. I got stopped here out one time, but there's a fixed rule set. So there's something that's called intuition and market experience, and this is something what comes over time with you. But a rule set is something what you have to stick to with the trading strategy. And saying always, we always need to place in an area 2 trades to see if we succeed, and the stop placement must be always on a low. Because if you have higher lows, that means if the market goes up and does you higher structure like this, if the market does you a lower low or something, it should right away go up again and do a higher low. And this is the main reason why you need to place always 2 trades, because it's an auction process. It's totally normal that the market wants to do lower lows. And this was the main reason why my reference was here with the closes of this color switch. I was entering even earlier. I saved some money here, by the way. And then my stop placement was again on the same reference. That means entering the trade here. And then I tried to force out here a risk reward ratio still of 5 up here. In this case, I was entering earlier. That's why my risk reward ratio actually happened already. But I could even trade with one more contract size. I didn't do that. Could have done that actually in the thought process. This was what I learned afterwards. But the thing is, it reached a risk reward ratio. Like if I would have used my actual entry point, it reached a risk reward ratio of 4.5. like around here. You can see here 4.57. And the thing is, what I lost here is for 4.57, a risk reward ratio of, as you can see here, 4.53, so 1.57, right? So that means if I adjusted $100 to make $500, I would have lost here $100 already. That's a risk reward ratio of 1. That's like another trade opportunity that I can take. That means starting off a risk reward ratio 3 or 3.5, I want to exit the trade. Because in trading, it's mostly about the mathematical side of finding enough trading signals where I can put in, for example, $100 to make it easy to calculate to get $500 out. This can be also done with $500 to get $2,500 out, or with $1,000 to do also $5,000 out on average. And here's the thing now. In this example here, if you lose 7 times $100 times 7 losses, we would have lost here $700. But if you win 3 or 4 times, let's just say 3 times $500, that's $1,500, right? You would still make with this, with minus 700 plus the 1,500, you would still make $800. And that's just something what's important. So you can crank the, you know what I mean? Like out of it, that means like you can do $1,000 a trade. You can lose 7,000. You can make 3 times $5,000. That was 15,000. And you would still make $8,000, and that can be transferred just making a living trading. So, and this is the main reason why you need a fixed rule set. This is why you need literally a fixed trading strategy. And the main reason what I see since 2019 training other students so far is that they don't understand that they need to collect signals and then write down the risk reward ratio for each signal. Because if you see sometimes you're losing $50 and then suddenly you're losing $500 for a trading signal with a very big stop loss, and you can just make maybe a risk reward ratio of 1 or 2, that means you can just like adjust $500 suddenly to make $300, and that's actually the main reason why you make money with a higher strike rate. That's actually worse for your trading. So you want to be organized to see that you have this 1 to 5 risk reward ratio, 30 trading opportunities, for example, within 4 or 5 weeks by just trading maybe 2 times or 5 times a week for 1 or 2 hours. Just that you're also timely, independent, free. Because I mean, trading should be a vehicle to lift also quality of life and not just make you a full-time trader.